Here is the number nobody put in the comparison chart: $162,000. That is what a 45-year-old with $80,000 saved today ends up with at 65 if they contribute absolutely nothing more for 20 years. And here is the second number, the one the same chart also hides: $347,000. That is what the same person ends up with if they add just $250 a month on top of that existing balance. No windfall, no inheritance, no perfect market timing. The difference between those two outcomes, $185,000, was not generated by finding a better fund or a smarter advisor. It was generated by one decision made on one Tuesday afternoon that took about 15 minutes to execute. Most people in their late 40s and early 50s feel behind, not recklessly behind. They have been paying their mortgage, raising their kids, covering health insurance, managing their parents' situation, and putting something into a retirement account for a decade or more. They are not gamblers. They are not spenders. They did the things you were supposed to do, and then they open their brokerage statement and feel a quiet, specific dread because the number on the page does not match the retirement they were promised when they started the whole thing. That feeling has a name. It is called a late phase misread. And it is not evidence that you made bad decisions. It is evidence that nobody ever explained the actual geometry of how this math works. Not your HR department, not the plan brochure, not the calculator on your bank's website. None of them explained the shape of the curve you are riding. And that is not an accident. The shape of the curve is the part that makes the boring advice work. The shape of the curve is exactly what the financial media has no product to sell you around, so it stays hidden. Today, I am pulling it out of the chart and putting it in front of you in plain language with specific numbers, because seeing it clearly is worth more than any fund switch you will ever make. Here is what I mean by geometry. Compound interest is not a straight line, and it is not a gentle slope upward. It is a shape that looks almost flat for a long time and then bends sharply. The final 10 years of a 30-year compounding window do not generate the same wealth as the first 10. They generate more than the first 20 combined. That is not framing. That is arithmetic. And the reason your statement looks underwhelming right now, if you are in your late 40s, is almost certainly that you are sitting exactly at the base of that bend. Not on the wrong side of it, at the base of it. Think about a river dam. The water behind a dam builds up over months, sometimes years, held back by the concrete wall. The reservoir gets deeper. The pressure keeps accumulating. To someone watching from a distance, nothing seems to be happening. The surface looks still. The water is just sitting there. And then the floodgate opens, and in a matter of hours, that stored pressure releases in a way that is completely disproportionate to how quiet it looked from the outside. The reservoir was not stagnant. It was accumulating pressure the entire time, invisibly in exactly the way it was designed to. Your retirement account does this exact thing. For the first 15 or 20 years, the balance grows in a way that looks almost insulting relative to what you put in. You deposit faithfully. The account creeps upward. You do the mental math and it does not add up to anything that changes your daily life. That is phase one. The dam is filling. And most financial content, most retirement calculators, most conversations you have ever had about money treat this completely normal phase one feeling as evidence that something is wrong with your strategy. It is not. The dam was designed to fill before it releases. Let me put real numbers on this because vague is useless. Every calculation in this video uses 7% annual return. That is the inflation-adjusted historical average of the S&P 500 going back to 1926, sourced from Robert Shiller's long-term dataset at Yale. I am not using 10%. I am not using a number engineered to make a chart look dramatic. 7%. Conservative. Honest. Now here is the table that retirement brochures never print. The only variable that changes across each row is the monthly contribution. The return is constant at 7%. The time frame is constant at 30 years. $80 a month, $96,000 at the end of 30 years. $150 a month, $180,000. $250 a month, $300,000. $400 a month, $480,000. $600 a month, $720,000. Same 7% return, same 30 years. The only thing that moved was the monthly deposit, and the difference between the $80 row and the $600 row is not a better fund. It is not market timing. It is not a stock pick. It is a number someone typed into a 401k enrollment form and then never updated when their salary increased 4 times in the following decade. The Department of Labor has reported that institutional inertia, meaning the tendency of workers to leave their contribution settings at whatever default was selected at enrollment, costs the average American worker tens of thousands of dollars in foregone retirement wealth, not because they cannot afford more, because they never open the screen to change the number. Here is something else the table hides until you look closely. The person contributing $80 a month for 30 years deposits a total of $28,800 from their own paycheck. The compounding adds $67,000 on top of that. Which sounds impressive until you understand that at $400 a month, the person deposits $144,000 from their own paycheck, and the compounding adds $336,000 on top. Same percentage return. 4 times the compounding output. Not because the market treated them differently, but because the percentage had a larger base to work on. The percentage is the same engine. The base is the fuel supply. In phase 1, the only thing that moves the outcome is fuel. I want to introduce someone before I go any further because the math is easier to hold when it has a name on it. His name is David. He is 51 years old. He manages operations at a regional distribution company outside Columbus, Ohio. He earns $86,000 a year. He has been contributing to his 401k since age 34. 17 years of consistent contributions, never missed one, never panic sold in 2008 or in 2020. He had a financial advisor set up a diversified fund mix in 2011. He has not touched the allocation since. His current balance is $112,000. He checks his statement every quarter, and he feels a specific quiet dread every time he does. He has run the forward math. At his current contribution rate and current balance, he is projecting somewhere between $270,000 and $290,000 at 65. He knows that is not enough, and he has started looking at alternatives. A friend mentioned real estate syndications. A newsletter he found on Reddit claims to regularly beat the index by 6%. A colleague at work is in a private equity opportunity with a minimum buy-in of $25,000. David is not being reckless. He is being rational inside a misdiagnosis, because David's problem is not his return rate. It is his contribution level. And the mistake he is about to make, the one that every single version of David makes when the statement stops feeling good enough, is the most expensive mistake in personal finance. Not because it is dramatic, because it is completely invisible in the moment and completely calculable in the rearview mirror. In a few minutes, I am going to show you the exact numbers behind what David's account looks like if he chases yield versus if he fixes the actual problem. The gap between those two outcomes is not modest. It is the difference between David at 65, choosing when to retire, and David at 65, choosing whether he can. But before I get there, I need to show you something about the structure of the problem, because once you see it, you cannot unsee it, and it reframes every financial decision you have made and will make from here forward. The financial media has a structural incentive to keep you focused on the wrong variable. Return rate generates content. Return rate generates product comparison. Return rate generates advisory fees, fund selection debates, premium newsletters, and YouTube thumbnails. Contribution discipline generates nothing. There is no product attached to increase your monthly deposit to a boring index fund and wait. That answer is free. It is the correct answer for the overwhelming majority of people in phase 1. And it is the answer nobody is monetizing. Which is exactly why you have heard the other answer 1,000 times and this one almost never. Here is the anti-diagnosis. And I want you to sit with this for a moment before I prove it with numbers, because this is the reversal that changes the way you read every financial article, every advisor recommendation, and every newsletter headline from here forward. You think the problem is your return rate. The actual problem is your contribution level, not in some abstract motivational sense, in specific calculable arithmetic terms that I'm about to walk through right now. Because this is the kind of argument that collapses without numbers and becomes irrefutable with them. David has $112,000 saved at age 51. He contributes $200 a month. He earns 7% annually. At 65, his projected balance is approximately $274,000. He knows that is not enough, so he starts thinking about his return rate. What if he could find a way to earn 10% instead of 7? Reasonable instinct. Here is what it produces. $200 a month, 7%, 14 years, $274,000. $200 a month, 10%, 14 years, $318,000. That extra 3% annualized, which is a number most institutional fund managers in the world do not sustain consistently, added $44,000 to David's terminal balance. Now here is what happens if instead of chasing yield, David keeps his boring 7% fund and increases his monthly contribution from $200 to $400. $400 a month, 7%, 14 years, $448,000. The contribution increase produced $174,000 more than the return-chasing scenario, without touching his fund, without taking on additional volatility, without subscribing to a newsletter or paying an advisor to rotate his allocations. One login, one number change, $174,000 additional dollars. The return rate is the interesting number. It generates the headlines, it fills the newsletters, it justifies the advisory fees. In David's specific situation, in the situation of virtually every Phase 1 investor with a balance under $200,000, it is the wrong variable to optimize. It barely moves the outcome. The contribution level moves everything. Now, the reason this matters beyond the math is behavioral. Chasing returns is not just ineffective in Phase 1, it is actively destructive. Dalbar, the financial research firm that has tracked investor behavior annually since 1994, published data covering the 20-year period ending in 2023. The S&P 500 returned approximately 10.2% annually over that window. The average equity fund investor captured approximately 6.8%, a 3.4 percentage point gap, not from fees, not from picking bad funds, from the behavioral pattern of buying after markets run up and selling after they fall. $200,000 for 20 years at 10.2%, approximately $1,400,000. The same amount at 6.8%, approximately $770,000. The behavioral tax is $630,000. Gone. Not to a bad company, not to fraud. Lost to the gap between what the fund returned and what the investor captured, because they went to cash in the fear window and bought back in after the recovery was already priced in. David's instinct to find a higher return vehicle is not irrational. It is a completely natural response to a real frustration. It is also the response most likely to cost him the most money, because the vehicles offering higher theoretical returns generate the most emotional volatility, and emotional volatility reliably produces the behavioral tax. Now I want to talk about something that costs David money right now, silently, every single month, that he has never looked at directly. Fees. Not in the vague fees add up way you have heard 1,000 times, but in specific, calculable amounts tied to his exact situation. David has $112,000 in an actively managed fund inside his 401k. The fund carries an expense ratio of 1.1%, which is completely standard for actively managed domestic equity mutual funds. Morningstar's 2024 fund fee study confirmed the average expense ratio for active U.S. equity funds is approximately 1.0%, with many sitting between 1.2 and 1.5. David also pays his financial advisor an annual fee of 1% of assets under management, which is the standard rate quoted by the Financial Planning Association for the roughly 38% of American investors who use an advisor. David's total annual cost, approximately 2.1%. He has no idea. It does not appear as a line item on his statement. It comes out of the fund's performance before the number reaches his account. Here is what 2.1% costs David specifically. $112,000 at 7% gross for 14 years. $274,000. $112,000 at 4.9%, which is 7 minus 2.1 for 14 years. $211,000. The fee structure costs David $63,000 on his existing balance alone before he deposits a single new dollar. And because the fee is calculated annually as a percentage of a growing balance, the cost is not $63,000 subtracted once. It is compounding against him every year, getting larger in absolute terms as the balance grows. The alternative is a Vanguard Total Stock Market Index Fund with an expense ratio of 0.03%. 0.03. If David is paying his advisor purely for the service of maintaining a diversified portfolio and rebalancing annually, he is paying between $40,000 and $90,000 over the remaining 14 years for a service Vanguard's website performs in 4 clicks at no cost. That is money that never makes it to the dam. That is pressure that never builds. That is compounding that was redirected before it reached David. I want to be precise about one thing. Financial advisors who provide tax optimization, estate planning, insurance structure analysis, Social Security timing strategy, those services carry real value and can be worth the cost. What is not worth the cost is paying 1% of assets annually for someone to hold a diversified index portfolio and send you a quarterly report. That specific service, in that specific form, is the most expensive way to do the simplest thing in personal finance. Now here's the thing about David that the forward math misses entirely if you only look at his contribution rate and his return. David has a car loan. He has had one continuously since 2009, the way most Americans do, according to Experian's 2025 data showing the average American carries a car payment for 53 of every 60 months. His current payment is $682 a month. His loan ends in 19 months. When it ends, $682 a month will be free. Most people in David's position do not decide what happens to that money in advance. Within 90 days of the final payment, the lifestyle has quietly claimed it. A slightly newer car, a slightly longer vacation, a kitchen appliance that seemed reasonable at the time. The money diffuses without a decision ever consciously being made. There is a specific window, the moment between when a recurring expense ends and when the lifestyle discovers the money is available, where the lowest friction, highest value financial decision of the next decade is available. That window is short. David's window opens in 19 months. Whether he is standing in that window with a decision already made, or standing in it holding $682 in freed cash flow with no plan, determines more about his retirement than anything else in this video. I said I would show you what happens when David fixes the actual problem instead of the misdiagnosed one. Here is that comparison with full numbers. Scenario 1. David chases returns, moves to an actively managed fund that theoretically earns 10%, but pays the behavioral tax and captures 7.5% after timing decisions. He keeps contributing $200 a month. At 65, approximately $294,000. Scenario 2. David keeps the boring index fund at 7%, cuts his total fees to 0.1%, and increases his monthly contribution to $400, which is achievable by redirecting half his car payment when the loan ends. At 65, approximately $460,000. Scenario 3. David moves to the index fund, cuts fees, and redirects $350 of the car payment into his account the day the final check clears. Monthly contribution becomes $550. At 65, approximately $580,000. The difference between Scenario 1 and Scenario 3 is not a smarter David. It is not a luckier David. It is not a David who found the right investment. It is a David who correctly identified which variable actually controls his outcome, at which point in the journey he is standing, and what specific decision to make at what specific moment. $286,000 of additional retirement wealth from a correct diagnosis. In the next section, I am going to give you the 3 exact actions that move this from a math exercise to something David and you can execute today. Not this weekend. Not when things settle down at work. Today. Because the geometry of the curve we discussed at the start of this video means that time is not neutral here. Every month David spends at $200 a month instead of $400 is not a missed contribution. It is a missed compounding opportunity on every future dollar that contribution would have generated. The cost of delay is not linear, it is exponential, and the specific dollar amount attached to 1 month of delay on David's situation is a number that, once you see it, makes the 15 minutes it takes to log in and change a number feel like the most obvious decision you have ever made. Here is the cost of 1 month of delay for David specifically. His account holds $112,000. At 7% annual return, that balance generates approximately $653 in compounding per month right now. Every month David spends at $200 in contributions instead of $400 is not just a missed $200. It is a missed $200 that will never sit in the account generating its own return for the next 14 years. $200 invested today at 7% for 14 years becomes approximately $522. Across 3 years of delay on that contribution increase, the aggregate cost in foregone terminal compounding becomes real and calculable. Delay is not a neutral decision. It is a permanent reduction in the output of every dollar that arrives with a shorter runway. This is the temporal truth that most retirement content never states directly. Your earliest dollars are your most powerful dollars. A dollar added to your account today at age 51 compounds for 14 years before you retire. A dollar added at 54 compounds for 11 years. The same dollar, the same fund, the same market. 3 fewer years of compounding reduces its terminal value by approximately 19%. That is not a trivial difference when you are talking about a monthly contribution that will recur 368 times between now and 65. 3 years of delay on a contribution increase does not cost you 3 years of compounding. It costs you 3 years of compounding on every dollar of every future contribution that now arrives with a shorter runway. The people who built real retirement wealth on average incomes were not smarter than David. They were not luckier than David. They did one thing David has not done yet. They treated the contribution decision as the most urgent financial decision they owned. Not the fund selection, not the timing, not the return rate, the contribution. They changed the number. And they changed it before the money existed in their hand, before the lifestyle knew it was available, before the friction of daily life had absorbed the window. Here are 3 specific actions. Not general principles, not suggestions. Specific, timed, minimal friction decisions that move David's outcome and yours from the first scenario to the third one. The first action: log into your retirement account today, not this weekend today, and find the expense ratio on every fund you currently hold. You are looking for the Fund Details tab or the Investment Options screen. There will be a column called Expense Ratio. If any number is above 0.5%, check whether a comparable index fund exists inside the same plan. In most corporate 401k plans, it does. It is usually labeled something like S&P 500 Index, Total Stock Market Index, or Target Date Index. If it exists and your current fund is above 0.5%, switch. That decision, made today on a screen you already have access to, is worth between $40,000 and $90,000 to your terminal balance, depending on your current account size and years to retirement. Morningstar's 2024 fee study confirmed the average actively managed U.S. equity fund charges approximately 1% annually. The Vanguard Total Stock Market Index Fund charges 0.03%. If you have been paying the difference for a decade, the damage is already done. If you stop paying it today, the future damage stops today. This action takes 12 minutes. The hourly value of those 12 minutes, expressed in retirement dollars, exceeds the hourly rate of almost any job in America. The second action: calculate your threshold date. Pull up any compound interest calculator. There are free ones on investor.gov and bankrate.com, and find the year your balance is projected to cross $200,000 based on your current balance and your current monthly contribution. Write that year down. Then run the same calculation with your monthly contribution, increased by $150. Write the new projected crossing date. The gap between those two dates represents the difference in how many years of accelerated compounding you access before retirement. For most people in David's position, $150 additional dollars per month pulls the crossing date forward by 2 to 3 years. And 2 extra years of the compounding curve bending in your favor, at the base of the curve where the bend is sharpest, produces more additional retirement wealth than a 1% return improvement held for a decade. That is not a motivational claim. That is arithmetic. Write both dates down. The gap between them is the number your financial life should be organized around, not your fund's annual return. The third action: pre-decide your next income event right now, while you are reading this, before the money exists. When is your next raise? Your next tax refund, your next car loan payoff, your next debt clearance? Write the approximate date. Write the approximate monthly amount that will be freed or received. Write the specific percentage you will redirect to your retirement account the moment it lands, not when you get around to it, not after you assess how things look at that point. Right now. The decision made in the abstract today, while you are holding no new money and there is no car dealership nearby and no kitchen renovation idea competing for attention, is the decision that actually executes correctly. The decision made in the moment while holding freed cash flow with no prior instructions attached almost never goes to investments. Your future self holding $682 of freed car payment money without a plan will spend it. Your current self making the commitment on paper today will invest it. That is not a character judgment. That is the documented behavioral pattern across decades of consumer finance research. Architecture beats willpower every time. Pre-decide today. Now let me close David's story, because I promised you a resolution, and the math earns one. David logged into his 401k 3 weeks after this conversation. He found his expense ratio, 1.1% on the primary fund and an additional 1% going to his advisory arrangement. Total annual drag, approximately 2.1% on his $112,000 balance. He moved to the Vanguard S&P 500 index option inside his plan. Expense ratio, 0.04%. He did not cancel his advisor immediately because he values the tax planning conversations, but he restructured the relationship to a flat annual fee for specific services rather than 1% of assets under management. His effective total cost dropped from 2.1% to approximately 0.3%. That single restructuring is worth approximately $70,000 in additional compounding by the time he turns 65. He also opened a calendar reminder for the 19th month from today with one line of text. Redirect $350 of the car payment to the 401k the day the loan clears. No decision to make that day. The architecture makes the correct choice automatically. His new contribution when the car loan ends, $550 per month. His new effective return after fee restructuring, approximately 6.7% net. His projected balance at 65, approximately $560,000. That is $286,000, more than the scenario where he kept chasing yield in a high-fee fund at $200 a month. $286,000. From 2 decisions and 1 calendar reminder. David does not feel dramatically different today than he did before. His lifestyle did not change. His salary did not change. The market did not change. What changed is that he correctly identified the variable that controls his outcome, and he designed a system that adjusts that variable automatically at the moment when the opportunity is available. He is still in phase 1. The dam is still filling, but the floodgate is now scheduled to open considerably wider than it was 3 weeks ago. If you are in David's position or close to it, the gap between where you are and where you could be is not a discipline problem. It is a diagnosis problem and a system design problem. The diagnosis is wrong when it says your return rate is the issue. The system is broken when it relies on your future self to make the right decision in the moment rather than your current self making it in advance. Fix the diagnosis, design the system, the math handles the rest. By the way, if this kind of analysis is useful to you, subscribe to the channel. I cover this type of framework every week. Not stock tips, not get-rich narratives, the actual mechanics of how long-term wealth accumulates and what specifically destroys it at each stage of the journey. The algorithm genuinely will not surface this content to you again if you do not subscribe, and the topics I cover in the next few weeks directly build on what we walked through today. 1 click, it costs nothing, and it keeps the analysis coming to you instead of requiring you to search for it. Here is the thing I want to leave you with. The geometry of the curve does not care about your regrets about the years before today. It does not reward guilt about contributions you did not make in your 30s. It does not punish you for starting later than you planned. The curve cares about one thing: how large is the base and how much time does it have left? For most people watching this video, in their late 40s or early 50s with some savings already accumulated, both of those numbers are better than they feel. The base is larger than it looks in phase 1 because the bend is coming. The time remaining is longer than it feels because the final decade does the work of the previous 2. You are not behind the curve. You are at the base of it. The dam is full. What you do in the next 30 days, specifically the 3 actions I just walked you through, determines